In today's video, we're diving into the pros and cons of existing properties versus house and land packages and which type of property could be right for your investment strategy. Hi, I'm Jay, a property strategist at Pinnacle Choice, where we specialise in building and managing property portfolios for hundreds of Australians. If you've been researching property investment, chances are you've looked at hundreds of properties by now, whether it's house and land packages or existing homes on realestate.com. And when you try to figure out which one to invest in, the internet is completely divided. So which option is actually better? Let's break down the pros and cons of both so you can decide which investment strategy works best for you. Let's get into it.
Okay, the pros for existing properties. Established locations often are in areas with proven capital growth. There's all the amenities, the infrastructure, and the demand. There's immediate rental income. There's no waiting for constructions. You can start generating income right away with your rents. The potential to add value to an existing property with the opportunity of renovations or improvements to increase the equity. Also, some existing properties have got larger blocks, so it opens up the opportunity of maybe putting a townhouse at the back where they're looking for more high density type properties. And then with the existing properties, you have all the historical data that's available. What that means is you can analyse the past markets, the price points, the time they're on the market, the demand in that area. You have all the infrastructure there combined with all the rental yields and where the market demand for rental is at that time. Now moving on to the cons for existing properties. You have high maintenance costs. The homes are a lot older, so they're going to need repairs and renovating to bring them up to market standard. Established properties have less depreciation benefits. The tax benefits are not as strong as a new build due to not being able to pass them claims over from the previous owner. With established markets, there's more competition. It can be harder to secure in high demand areas. The entry points are higher, but there are also more buyers wanting to get in those spots. There are unknown issues which can cause more costing. Structural integrity is important, so you have to get engineers in. There's hidden problems that sometimes you don't know about that can't be seen, so the risk is a little bit higher. The pros for house and land packages. Customising, you can choose the design, the layout, the features to suit the market and demand. With house and land packages, there's government incentives. There's first homeowner grants, there's stamp duty concessions, they also may apply. There's also tax claims. With house and land packages, there are no maintenance and repairs in the early stages. Everything is brand new that comes with warranties. Reducing upfront maintenance costs is really important. With house and land packages, you have high depreciation benefits. There's larger tax claims, especially in the first 3 to 5 years. You can claim the build and all your out-of-pocket expenses. House and land packages attract tenants, meaning the property won't sit on the market long before it gets rented, as people are always out in the fridges looking for new homes to raise their children. Cons of house and land packages. House and land packages, there's higher upfront costs. It may require deposits on the land and construction deposits separately. House and land packages are location risk, often building out of suburbs with unproven growth potential. But in modern day, the one thing our governments do is really good infrastructure. We will often build infrastructure first before we build these suburbs. So that's a con and a pro. As you can see, there's pros and cons on both sides. Where one side you're paying high stamp duty and the other side you're paying construction costs. They all balance out. You just have to be happy with the area that you're going to invest in, and you make sure there's capital growth, because we actually retire on capital growth. That's it again for another video. Make sure you like and subscribe, and I'll see you on the next one.